Well, good morning, everyone, and welcome to Stanford University. We're very pleased that you have joined us for the inaugural Directors College for Venture-Backed Company Directors, VCDC. My name is Evan Epstein. I'm one of the co-directors of VCDC and the executive director of the Rock Center for Corporate Governance, which is a joint initiative between Stanford Law School and the Stanford Graduate School of Business. Before we start with the program, I'd like to thank a few institutions and people. First, the sponsors of this program, Silicon Valley Bank, NASDAQ OMX, and PricewaterhouseCoopers. Not only have they given us a generous financial support for the program, but they've also provided great advice and guidance in putting this event together. Second, the advisory committee of VCDC, Jason Doran from Silicon Valley Bank, Danny Wallace from PricewaterhouseCoopers, Joseph Brantuk from NASDAQ, Sean Conway from Andreessen Horowitz, John Watkin from Stanford Law School, and Miriam Rivera from Ulu Ventures. All these people have provided valuable time and knowledge in helping us set up the structure and content of this event, so we thank their generous input. Third, Vice Chancellor Travis Laster from the Delaware Court of Chancery. We've been lucky to host the Vice Chancellor all week at Stanford Law School, and it is a great honor to have him with us today as a keynote speaker, considering the pivotal role that Delaware law plays in the corporate governance of venture-backed companies, most of which are incorporated in Delaware, of course. Fourth, Equilar Engage, the online platform tool for this event. You should have received an email earlier this week with instructions on accessing the online platform. We highly encourage you to use Engage to check out fellow attendees, reading materials, and especially to provide instant feedback on sessions. Finally, my fellow co-directors of the program, Professor Joe Grundfest, Professor Dan Siciliano, and Scott Kupor from Andreessen Horowitz. And finally, but not least, our Stanford Law School program group, who do all the hard work with the logistics, Trish Gertrude, Jackie Del Barrio, Jody Carrion, Aaron Lee, and Casey Limchenko. So let me tell you the story about how this program came together. As some of you know, 2 decades ago, Joe Grundfest and Stanford Law School pioneered the first executive education program for senior executives and corporate directors of public companies called Directors College. Today, this program has become the leading executive education program of its kind under the leadership of Joe, Dan Siciliano, and Simon Lorne, who is the Vice Chair and Chief Legal Officer at Millennium Management and the former General Counsel at the SEC. Now, to give you an idea, our main Directors College has between 250 and 300 senior executives and directors of public companies that spend 3 days with us at Stanford in June to get immersed in all issues relevant to public boards. So a few years ago, we discussed the possibility of considering or creating a specialized Directors College for private companies, an idea that allegedly has been around for about the same 20 years. Now, the reality is that the challenges of serving as a director of a public company as compared to service on a private venture-backed board are sufficiently different that we believe a new program to serve the venture community is long overdue. It wasn't until a year or two ago that we seriously took the task of putting together this VCDC program. We were fortunate to work with Scott Kupor, a VC at Andreessen Horowitz and a former Stanford Law School alum, who concurred with us with this idea of putting together a specialized format for VCs. So we thank Scott for helping us think through all these issues, and we're very happy to finally have this program make it a reality today. We've assembled some of the top thought leaders in corporate governance and venture capital. The plan is to go through some of the basic duties of venture-backed boards and work our way through the more complex and nuanced issues faced at this level. Amazingly, there are no programs of this kind in the country. As you may imagine, we think that Stanford is uniquely well situated to address these issues, and more importantly, we can beat Yale, Harvard, and any other East Coast school in structuring one of this premier corporate governance program for venture-backed boards. The fact is that most of the VC investments happen just around the corner here in Sand Hill Road, and it is quite remarkable that it has taken this long to execute on this need. Over the course of the last few years, I've also talked to many VCs, and the reality is that each one of you has a different opinion on how to run a board. As opposed to public company boards, there is nowhere you can go to get basic training or a crash course on how to run a well-functioning board. And although not by design, the limelight of corporate governance has been shining over Silicon Valley lately with dual-class stock structures, the eBay situation, and other cases involving apparent conflicts of interests. And as we read through this news, we can identify several misconceptions and a lack of basic knowledge about the role of directors, both on the private and the public sides. So we hope that the session today will provide some valuable information that helps you discharge your boardroom obligations more efficiently and adds value to every board on which you serve. We appreciate that you're subject to time demands, and we are grateful that you have chosen to spend the day with us. We've provided some reading materials, including Brad Feld's new Startup Boards book, which is a good starting point, and we actually invited him to speak today, but he told us he wasn't traveling for business in 2014. So good for him. Of course, we would appreciate any feedback you can give us to make this a better program, and hopefully VCDC can also become an annual fixture, just like its older brother from the public company side. We welcome you to Stanford, and we look forward to an exciting set of sessions. Thank you. Joe.
All right. All right, so again, in case you didn't hear me the first time, he's Larry, he's Gordy, I'm Joe. Those are the introductions. I think that's pretty much all we'll need. And to kick this conversation off, with a patina of high intellectualism that might be appropriate to Stanford University, let me start by posing an existential question to my two colleagues, and that's, why are we here? Why is it that, to the best of our knowledge, for the first time in the history of Silicon Valley, we're gathering to have a conversation around the topic of corporate governance in Silicon Valley and in the startup economy? Why is now the right time to have this conversation?
Well, Joe, I'll throw it out, and I'm sure Gordy will follow up. I think it's several things, quite frankly. No one particular event. I think it's obvious that the whole issue of governance is a very big topic in corporate America and a very big topic in our markets today. We've seen people articulate it different ways, a shift to somewhat of a shareholder-centric governance from a traditional board-centric governance, a topic that we'll cover probably in depth on another subject another day. And as Gordy was mentioning this morning, the dollars involved in our transactions, in our venture-backed transactions are different. They're larger, and we have more of a diversification of investors. Now we have angel investors, micro VCs, growth funds, hedge funds, private equity firms. So the stakes have gone up, and of course, to state the obvious, the successes are huge, and they're great, and they're disruptive. And I think these are some of the factors.
And Joe, as a result of that, they're front page news. They're on the front page of the business section, on the front page of the Wall Street Journal, and they're getting attention. I mean, you see the publicity that the WhatsApp transaction had, for example. You've spoken about that earlier in the week. Venture capital has become very topical, and there's more, just the internet has made a lot more information available about how Silicon Valley works and how the venture capital model works. And we've seen the innovation that's been driven by venture capital-backed companies, and they've resulted in real dollars. And sometimes when real dollars are at stake, litigation ensues. So we've seen, more activity in the courts, and particularly in Delaware, where many of the venture capital-backed companies are incorporated.
Well, one of the things that I think is also pretty clear as you look at the corporate landscape, it's very easy to draw a contrast between most large publicly traded corporations, how they're governed, and how we govern ourselves in the startup economy in Silicon Valley. And let me do a caricature, all right, for the specific purpose of highlighting the difference. Typical large publicly traded corporation, you've got about 11 people on the board, you've got the CEO, and you've got 10 other people. Recent research suggests that many of these companies, these 10 other people, have no one from the same industry, no one with deep knowledge of the particular space, and questions are asked about the fact that you've got wonderful independence, but are these independent directors sufficiently knowledgeable to press management, to press the CEO about strategy, capital allocation, and other very important business decisions made at the company? Just absolutely squeaky clean with regard to a whole bunch of legal compliance issues, but you'd really question the ability to contribute on the business area. Silicon Valley analog. 3, 4, 5-person board. Everybody on the board is, in one sense or another, conflicted. You're either a partner, all right, at a venture capital firm that's invested in the company, a senior executive at the company, or a designee of a venture capital firm that's invested in the company. In the venture capital model, everybody is there for a reason, all right? Everybody's there because they know the space. I've been in this space before, I've done it, I know what the competition is like, I can help with the technology, I can help with the strategy. By the way, by technical definitions, every director in that situation would be considered conflicted one way or another, okay? Main value add of the Silicon Valley board is business. Figuring out how to build a successful product, get the product to market, and succeed. The world, in terms of what you read about in the Wall Street Journal, is very fashioned by the 11-person board, 10 of whom are independent. Silicon Valley, much lower profile. We live in an environment where conflicts, as lawyers look at them, are common. The challenge that I think we're going to face is we're going to have greater awareness of these conflicts, and we're going to have to develop greater skill in terms of managing around these conflicts in a way that doesn't destroy the tremendous value of this business model, where there's a huge amount of business intelligence that gets brought to bear in terms of a very active and involved board. Gordy, Larry.
Joe, you put it in, as you said, you made a caricature. I mean, you've emphasized the conflict. One of the things about Silicon Valley and venture capital-backed boards is the confluence of interest, not the conflict of interest. The overriding truth is that in most cases, the venture capitalists and the founders have the same interest, which is to build the company and achieve value. The difference between the public company model that you outlined is what legal theorists call the agency model. You have an absentee owners, shareholders that are maybe anonymous and they're fluid. So you appoint these 11 distinguished directors to be the agents for the shareholders. Often the directors have little, if any, financial interest. Contrast Silicon Valley. Everyone in the room has a substantial financial interest in the success of the company. I mean, in certain ways, it's the best possible governance. You've got skin in the game. Shareholder activists, or or inviting themselves to board meetings of public companies because somebody on the board should actually have a financial interest in the company. There are ISS and others are recommending that board members own a minimum number of shares so that they have skin in the game. Here you've got the perfect result. You've got the substantial stakeholders in the room making the business decisions in the best interest of the shareholders. They are the shareholders.
And that at root is why the model works.
In most cases, it's not a conflict, it's a confluence of interest.
Larry?
Totally agree. The social responsibility is different, as Gordy's pointing out. In a venture capital model, we all come together with the same motivation. We know what the stakes are, and we know what the bargain is. And we come together, and we are collaborative in the main goal. Can we build a successful business? The conflicts, if they arrive, deal with the duality of the relationships. One provides capital, the other provides management. One provides oversight, one provides operational. These conflicts are not negatives. You can't eliminate them. I think Gordy's suggesting they are necessary. They're symbiotic. I think the bargain is made when we come together. The issue, though, that I think that we have to address is what is the role of governance in that environment? Is there a role for governance? And I think there clearly is. And the question is, what we're observing today with increased litigation, where these conflicts bubble up to the top, what's changed? And in my view, nothing has really changed other than the stakes have gotten higher. But if there's one thing that is clear, is that I think there's a place for governance that will really enhance the business model. And that's a debate we ought to get into.
Well, when we look at the question about the role for governance in Silicon Valley, the ideal situation would in many ways be to reduce the litigation risk without adversely affecting the business success of the model that we've been running. And to try to drill down on that question, what's a sensible thing, if anything, for Silicon Valley to do? A perfectly sensible result may be, let's not change. All right, this is working reasonably well. There'll be a heightened possibility of litigation. Well, that'll be a cost of doing business. We'll absorb that cost of business and we'll move on. The reality is, to date in Silicon Valley, disputes are common, litigation is rare, and the concern that I think the three of us have up here is if we look at recent decisions out of Delaware courts and other locations, we're not at all comfortable that that equation is going to carry forward in the future. Disputes may still be common, but litigation may also be more common. And to understand why that's the case, what are the factors that typically lead to disputes that morph into litigation?
Well, I think that it comes down oftentimes to fundamental decisions. You need to raise more money. That requires setting terms, setting price, and deciding, what the goal is for the use of the money. If you have a venture capitalist on the board that has put in money, and if they make the decision, we'll put in the next round, the inherent conflict is there. Who sets the price? Who sets the terms? What is the governance standard? Is there anybody independent, or should there be anybody independent to make that decision? I don't think so. But there is a process. Maybe we should test the market and find out who else would invest and on what terms. Another example, Joe, is, as we all know, is sale of the company. Oftentimes, the venture investor has a liquidation preference. They get their money out first. Well, if the company is doing phenomenally well, everybody is going to make out. But what if the company can only be sold at the liquidation preference? Is there an obligation to set aside money for the common or the junior preferred? Or can I adhere to the bargain of my contract? And I think those are just two examples we see constantly every day. And the issue is, what is the process? Because litigation is going to be heightened. And what is the solution? Gordy?
It is about process. And, I think that The legal standards align pretty well with common sense, actually. And you know, Larry hit on one, which is if you need more money and the current investors are willing to provide it, maybe you should test the market. Maybe you should, you know, see what a third party would would invest at before you determine a price, and that's good for everybody. And but if it's something where the management just wants to get the financing done and they're satisfied with the price, it's a substantial uptick from the last round. You know, if everybody's in the room and everybody's informed, then you can make that decision. If there's a disparity of information, the management team thinks that it would like to test the market, you know, let it. I mean, do it efficiently, but let it happen.
You know, it might be good to set the stage of what's the threat, what are we concerned about, and it really comes down to who carries the burden of proof. You know, in Delaware, if you adhere to the business judgment rule, duty of care, duty of loyalty, then you really shift the burden to the plaintiff to prove that the transaction was either unfair or unjust or whatever. Where you have a conflict situation, where you wear two hats, that duty of loyalty is totally diluted away. And therefore you shift to a different standard, a fairness standard. And the burden of proof now shifts to you, which gives the plaintiff all the leverage. So what we're really talking about is the bargain for the litigation. This is why we have the problem. And some people may argue the fairness standard should not apply to a venture capital situation because the social responsibilities and obligations are different, as we noted. That really, I don't think, is the case or should be the case, but that's the debate. On the other hand, you may ask yourself, well, maybe if we follow a proper process where we can meet standards of fair dealing and fair price, maybe at the end of the day we prevail. But notice, as Joe and Gordy are alluding to, now we're in litigation. It's expensive, it's time-consuming, it's disruptive, and I think there's where the real debate is going to be. I hope we don't have to change our structure, but I do think we have to be aware that this shift of burden of proof, which gives different people different leverage, can be disruptive to the business model, takes time, takes cost, and that's going to say that we've got to really, really focus on these conflict issues and have the right process to be sure that that temptation to litigate is diluted.
You know, one of the ways that I look at these situations when I run across them in the Valley is I try to rank the behavior that a company's involved in terms of whether it's high risk or low risk. And there's certain kinds of behaviors that are higher risk. There are other kinds of behaviors that are lower risk. And in each one of these situations, there's steps that a board and management can take to reduce the litigation exposure. And it's a rational question as to whether you want to take those steps. It's as though you're buying an insurance policy. And the question for you to ask is, how much does it make sense to invest in process and other steps in order to try to reduce that litigation risk? Reasonable people will differ over the reasonable steps to take given exactly the same situation. But once you've lived long enough in the Valley, there's a certain rhythm that comes up, and there's certain situations that we can anticipate have the highest degree of litigation risk. So let's take one real concrete example. And this is the situation that came up in a very recent decision in Delaware. It's called the Trados case, and it's a situation that will be extraordinarily common to everyone in the room. You've got a company. You've invested money. You've put a lot of hard work into it. At some point, you realize it's not going to turn into Facebook. Okay, happens all the time. What we're going to do is we decide that the best step to take here is sell the company. We got a stack of preferences. Let's assume the preferences total about $60 million. We go out, we test the market, we find that we're able to sell the company for around $60 million. And at the end of the day, there's not going to be anything left for the common. In the course of doing the transaction, We have a management incentive plan. We give management a reason to be involved in the transaction, perhaps in some situations to stay on after the deal is done. But at the end of the day, there's not going to be anything left for the common. At some point in some situation, you might have a holder of the common who says, wait a minute, this was my big lottery ticket. This was my chance to win. This was the only way that I was ever going to make it big, and I think that the board of directors here took advantage of the common, and if they just would have let the company operate on its own, this company would have been worth $150 million, $250 million, and the directors, all of whom are representatives of the preferred, decided to get out early before we had a chance for the big home run. Why? Because they got all of their money out, and they did it in such a way that disadvantaged us, the common stockholders. That may be the most common high-risk situation that we run across in the Valley. Gordy, Larry, could you just expand on how these situations evolve, and what are the kinds of things that a board can think about in terms of lowering the litigation risk, and how expensive is it to take these steps?
As you know, it's not a hypothetical case. It's a case authored by the Vice Chancellor who's with us, and we've already talked about it earlier in the week, and I think the rest of the day there'll be more discourse about it. But it's a very thoughtful opinion. It's a little long by Silicon Valley business reading standards, but it's worth every page because there's a lot of learning in it. Joe, you said that all of the directors were venture capitalists. In fact, there were one or two arguably independent directors.
Correct. I wanted to simplify the hypo because once you've got somebody who's independent, the courts then look at these independent directors, they pick them up by the legs, they shake them, all right, and they want to see if something that's not independent falls out of a pocket, all right? So to keep the hypothetical simple, I sort of figured, let's start by just assuming that everybody's going to be determined to be conflicted.
Let's just give a simple answer to your question, then go to where you want to go. One of the measures you could take to reduce litigation, which the Vice Chancellor mentioned, is you could appoint a committee of disinterested and independent directors and have them make the decision.
Exactly.
That wasn't attempted here. It's putting a lot of pressure on one individual, and I've almost never seen it done, but that happens in public companies regularly when you have a management buyout, for example, and that's the normal practice. Mm-hmm. But it's just not the normal practice in Silicon Valley because there aren't professional independent directors who want to take on that risk.
But it's something for people to think about.
Just park that thought. I mean, that's one thing you can do. You look at that fact pattern, and to me, here's where I think common sense would have prevailed and could have avoided the litigation. You've got $60 million offer for the company of $58 million of liquidation preference. There's $2 million left over for the common. Not much, but something. To incentivize management to go out and find the best price, they created a management incentive pool, not unusual in Silicon Valley, that had a sliding scale, but call it 13, in this case it penciled out to 13% of the proceeds, went to the then current management, who, by the way, had some common interests.
Yes. And
the 13% was reduced by what they got for their common stock.
Right.
So they had, their interests were, somewhat aligned with the common because they had common. If you pencil it out, there's $2 million at issue here out of a $60 million push result, right? The venture capitalists said, we have other things to do with our time. We'd rather just get our money back and move on to the next adventure. The founders who were not on the current management team said, this was my lottery ticket. You may have other portfolio interests, but this is my lottery ticket. Keep the company going on the hope and prayer that maybe there'd be something left over for the common. In hindsight, it would have been better to charge most or all of the management incentive pool to the preferred stock, reduce the payout to the preferred stock, and not zero out what went to the common. It's $2 million at stake, most of which would have gone to the management incentive pool anyway.
But Gordy,
so my point is just do the math. We're fighting over a small amount of money here.
But the thing that, yes, you could do the math and lower the litigation risk, but I thought the opinion was really a model to follow. You're sitting there with a company and you've made a decision that the standalone plan doesn't work. In other words, it's not going to yield value greater than $60 million. Right away, I think the Vice Chancellor is saying, have a process that really tests that standalone plan. Build a record that you work the model. You have a history. You've had 8 consistent quarters of lower margins, losses, loss of revenue. Take a look at the situation. Secondly, test the market. Okay, if the standalone plan isn't working, you're losing employees, you're losing vendors, customers. Is anybody going to pay more than $60 million? And at the end of the day, I think the process comes out. I don't think you have to cut the deal that Gordy's saying you cut. That may be a very smart, common sense thing to do to avoid the litigation. But I think the liquidation preference could take all the money off the table. That was the bargain that was made with the common stock. That was in the charter. That's what we voted for. That's what we agreed to. I don't think the opinion is saying you have to break the bargain. I think what it's saying that is where you don't have independence, you better have process. And you better be sure that that standalone plan, within reason, doesn't work. And you better be sure that that $16 million can't be beat by someone else out there. I don't think you have to take the management incentive plan and allocate it to common or preferred. I think you have to have a business rationale. In order to test the plan, in order to sell the company, we've got to keep the management team incentivized. We got to keep them in place. If you build that record, I think you can do that. So what my takeaway is that there isn't anything revolutionary in the case other than to say, look, these are the governance principles. If you don't have independence, you're going to be bumped up to a fairness standard, and you're going to have the burden of proof of fair dealing and fair price. That's the bargain you make for not having independence. I don't think the opinion is saying we got to go hire a bunch of independent people and try to find them. Because at the end of the day, in this valley, I don't know if anybody's truly independent. But I do think it focuses on the need to do the homework to make the judgment.
A couple of other quick thoughts on this.
By the way, I would challenge you on people in this valley being independent.
Joe, you would be independent.
Joe's our role model. Heidi. Sure.
Let me repeat the question. Does it make a difference whether the company is profitable or unprofitable? Because if the company is profitable, the common's got a stronger argument.
Yeah, Heidi, I think those are great questions. To me, it doesn't matter if it's profitable.
Larry, could you repeat the question?
So the question was, does it matter if the company's profitable as opposed to not being profitable on this process? And second of all, if you have an independent director and they're part of the management incentive carve-out, are they in fact no longer independent? I mean, great questions and whatnot. On the first case, whether it's profitable or not profitable, to me, it's just a question of judgment. Of whether or not the rate of profitability can sustain longer-term value discounted on a present value basis that would be greater than $60 million. If so, it suggests that it would be in the interest of all shareholders to keep plowing ahead, as opposed to saying, I'm going to take my liquidation preference off the table, I'm going to invest it in another startup that is competitively going to be better. I mean, there's the tension. And I think that you inherit that obligation not to pull that preference off the table unless you can carry the burden of proof. Otherwise, you keep going. I do think the independent director that's part of the management incentive, Gordy, that's a great question. I think that there could be independence there, even though they get a cut of the pie. What do you think?
Well, certainly, if the common is going to share in that, then I think it helps. But I think it's not helpful if the common isn't going to share here, and that's why I say, Joe started this conversation, how can we avoid the litigation? Not how can we win the litigation. Right. We can win the litigation by proving that the discounted cash flow and so forth is going to be better or worse than selling the company. And in fact, in the end, though the case is frightening to everyone in the room, the Vice Chancellor did his own math and said, you know what, it didn't pencil out, that the valuations that the two parties had really weren't completely airtight, but just looking at it, it's clear to me that there was no value in this company. So despite the fact that it was a very substandard process, there was no money here, so there's no case. So the result of the case is actually right. It's just that I don't know how much money and time and effort was spent. And so I'm just saying, be practical. Do something that's going to avoid the litigation.
So this point about being practical, I think, is extraordinarily important. First, as a practical matter, as both Larry and Gordy observed, the commonality of interest in Silicon Valley, I think, far outweighs the situations where you get real conflicts. Because when people come to the table and say, we're going to start this company, they're not coming to the table and saying, look, we're going to start a company and we're going to have a zombie deal over here, that we're going to have something that's going to be running sideways at very low levels of ROE for long periods of time and isn't really going to have an interesting exit for anybody, all right? That's not why anybody does these deals. People are doing these deals because they're looking for the top decile. Common is looking for that. Management is looking for that. The VCs are looking for that. A situation where you have barely a pulse going in the company, and yeah, you could see it going on for decades at a very low level of return. That, again, is not why anybody ever got into the deal at the beginning. And the question is how to work an appropriate exit for many of those situations. And it should come as a surprise to absolutely no one that people are involved in this process for the extra normal returns, all right? And again, that's very different from the budgeting process that you're going to see at a General Electric or what have you. What can we in Silicon Valley do, ideally, to eliminate the risk of litigation in these situations, or if you're unsuccessful in that situation, lower the probability of an adverse judgment?
So there's a legal thing, and Vice Chancellor last year pointed it out in a footnote, which is the surprise to, I think, Silicon Valley is the Delaware law that the board of directors owes a fiduciary duty to the residual owners of the company, the common owners, and that the preferred stock holders have a contract right, but they're not necessarily protected by the fiduciary duties of the board. So if you get this question of, is there going to be anything left for the common?
But does there have to be anything left for the common?
No, I understood. But the solution here that Vice Chancellor, posited as a question is, can you contract around this? Can you change the underlying rules of the game in the certificate of incorporation that says that in an event like this, where in the reasonable business judgment of the board, that the company does not have prospects that will likely lead to a return for the common, it's okay to sell the company for the liquidation preferences, and that doesn't violate fiduciary duty. That doesn't even invoke the entire fairness standard, that this company is making a private change to the law that says this is something that the board can do, and that may change the relative leverage in the litigation so that no litigation would be brought, because it would be maybe then judged by the business judgment rule that Larry talked about at the beginning rather than entire fairness. And the NCVCA forms have put sample language to change that. The language might be too general to work. I asked Vice Chancellor Laster this the other day, how does he envision this? And he said, it would have to be pretty specific probably to be effective. So you'd have to describe the situation with some particularity, but you could change the.
But you know, I think the bargain changes when we have just the founders, key managers, and the VCs at the table. We pretty much, in the adage of the security law, could fend for ourselves. We have access to the information. We have access to the relationships. We pretty much know the bargain we're into. What's happening to our companies, though, today is we are, before we ever get public, we're getting very big. We have employee ownership of thousands of people. We have people who are coming to work relying on that equity return, taking less cash compensation, working 18 hours a day. Our duties change, and these contracts that Gordy's suggestion may work when we can all fend for ourselves, but this expanded populace of employees, and now we have the secondary market going on, when we have trading in private companies, and our security laws, as you know, have expanded to allow us to have a couple thousand shareholders and still be, quote, private. I don't think you can contract away the fiduciary duty obligations in that environment. I think the expectation of that large minority out there is someone is going to be exercising reasonable judgment for the investment I'm making. And so at the end of the day, I think that the solution is going to be less contractual and more process. I think it comes down to transparency. I think it comes down to candor in the boardroom. I think it comes down to proper motivation, and it comes down to process. Yes, we may have litigation. Yes, we may lose the shield of the business judgment rule because we don't have an independent majority of the board. But I don't think it means at the end of the day that we can't make sound business judgments and prevail.
So one of the things that's
Sure,
really...
that's a question.
Yeah,
Scott?
sorry. So excellent question, Scott. Let me try to summarize it and condense it a little bit, and correct me if I miss the gist of the question. We have transactions in Silicon Valley now that are often called acqui-hires, all right? And I think your question goes around the acqui-hire. And in an acqui-hire, what you discover is the value of the company is calculated something along the following lines: $2 million per engineer, minus $500,000 per MBA, minus $5 million per lawyer, all right? So you look at the staff and you figure this is the takeout value of the company. The company's being acquired not because the acquirer really cares about the product that this company has been building or about the revenue stream. In fact, in many situations, you do the acquisition and the next thing you do is you shut the company down immediately. It's being acquired because the tech team is so valuable. Because skills are so hard to find in Silicon Valley that getting a group of people that have established they know how to build a damn good product and they can work well together with each other is worth more than the product that they're actually building. And when you cut that deal, what you're often doing is throwing a lot of value to the talent. You're throwing value to the employees. You're, in effect, throwing value to, if you look at the cap table, the most junior slice of the cap. And in order to do that, in some situations, you've got to tell the preferred, look, you're not going to get 100 cents on the dollar. But by the way, we really don't care about the investment you've made in the product. We care about the people and the team. And what this actually does is it takes the traditional Wall Street model and the way lawyers and vice chancellors look at a deal, and it turns it upside down. What it says is the formal legal preferences that have been baked into the charter are totally worthless, all right? The real economics is the power is with the 23-year-old coders, all right, who really know how to write great code and make this thing work on mobile. So we're going to be throwing a lot more money at them. Preferred, you're going to have to take a slice back. Larry, Gordy, what kind of issues do those raise?
Well, Scott asked a specific question, so we shouldn't lose it, which is not the conflict between the management and the preferred, but between the controlling class of preferred and the minority who are not represented on the board. So as to your pure question, just preferred versus common, I mean, I think you've got the players in the room. Again, the preferred can negotiate, the management can negotiate. Ultimately, the acquiring company who has the money will have the bargaining power, and most of those deals just get done. I do worry about Scott's question often in not only acqui-hires but in other deals where there's a different waterfall. And Joe had asked us to think of do's and don'ts and big mistakes. You should try to keep the cap table as simple as you can so that everybody's pari passu and pro rata, so you don't have these funny discontinuities in the distribution of proceeds on an acquisition. That's where I see the most acrimony, actually, is when you get a deal that's right on the cusp of triggering a payment to this, the Series A or B, which, by the way, was a company that was acquired in Australia that had, some of the former founders in it, and they're not around anymore, and nobody cares about them, and they're not present in the room, and they're a junior preferred. They get their money after all the other preferred. That's a real conflict, and that's one where I worry more because they're not even present anymore, and there's I think the Delaware law is probably they made a contract and they're stuck with it because it's the preferred. Hopefully that's the answer in this case. But if you have alignment where all the preferred are pari passu, they just have different prices. And the majority of them are willing to take less than what they would hope for the deal, and the acquirer is saying, I'm really buying the talent, I want incentives going forward, and some of it's future vesting. I don't think there's much of a risk there. Larry, any other
question?
Thoughts?
So I'm thinking about this is a more significant, larger acquisition where the acquirers have sort of figured out management, and by doing that is to say, well,
Right, so here the question is, another structure that's not rare is the bidder comes along and is in effect luring the management team with very large options that are going to be tied to their future employment, and the management team says, this is going to be a better deal for all of us en masse than staying with the business plan we have now. So a lot of the real value on the table is never even really presented to the preferred for the preferred to be able to get.
And this is becoming very common and is common in large deals. In fact, a company acquirer who does this very, very well is IBM. If you look at the deals they do, they get it and they'll set aside a $20 million pool in a very big deal and say, this is going to be for management. And I do think that here is where we've got to have some governance in the boardroom on these big deals. First of all, you got to educate management not to go off and cut that deal ahead of the board. That's number one. I've seen that situation happen. Management is meeting with management of the acquirer. We understand your preferred and your common, but we've got this big pool, here's how it's going to work, and management spends a lot of time cutting that deal. I think you got to pull that back. To me, that is very similar to a going private transaction, where you keep management away from that private equity firm cutting the deal for the future. And we've done a very good job in process in doing that. Those management deals aren't cut until the deal is really done. That's point one. And I think to do otherwise, now management is putting itself and the board in a tough spot. I think the second thing is when you do those big deals and it comes to divvying up the money, to Scott's point, I think the stakes really are just as high there as in the dilutive situation, if not higher, and the conflict is higher. And here's, I think, where you've got to have a timeout and you've got to come together in the boardroom, even if there is no independent party, and lay out your process and figure out, okay, who are the constituencies? How is this pie going to be sliced? And really, how are we going to deal with this from a fair dealing viewpoint and a fair price viewpoint? There's no, Scott, I think, easy answer. There's no right way, mathematical way. But I do think it accentuates getting ahead of the process and laying it out. Oftentimes in these deals, in private companies, management is cutting deals before really the board sees it. And I think that is a disaster scenario happening.
Gordy?
I agree with that. The one thing I would add is I still come back to doing the math. I mean, I had a situation similar to the one that Scott mentioned, and it had elements of the second question too. When you have a complicated cap table, do the spreadsheet and just see what happens, because sometimes the emotional argument gets larger than the number of dollars at stake. And maybe you make a different bargain when you see that it's really only changing a few dollars. It comes up in the uncertainty situation. You have there's a management incentive pool, there's an earnout, there's an escrow, and there's a special escrow for a certain pending litigation. And so you've got four things that could vary after the closing. And that's when you fight about, well, who gets what share of what, and you have to run the different scenarios with a spreadsheet, and you see that, you identify the corner cases, and sometimes you can just say, okay, all right, we'll just, it used to be a junior series of preferred, we'll make you pari passu. And it doesn't matter a whole lot. And you can avoid the litigation. But I completely agree with Larry that, management can't be out there ahead of themselves, selling. And this is actually, going back to your first question, the conflict, there's a balance of power here.
Key.
The venture capitalists worry that the management won't, be good stewards of their money and make it successful. And the management worries that the venture capitalists will somehow squeeze them and not fund them at the next round. And so there's this balance where they both need each other.
And that's why it works.
And that's why it works. Exactly.
The constructive tension that exists is good. It's how we build companies, and I think you don't want to eliminate that. That's why I don't knee-jerk to a solution to say we got to go and hire a bunch of independent directors who have no association with the business to make these decisions. I don't think that works. It may work for the business judgment rule, but I don't think it builds the kind of companies we need to build. On the other hand, I think we've got to realize that we are doing some phenomenal things in building great companies, creating great jobs, advancing technology, but we're touching a lot of constituencies, and I think there is a social responsibility to governance. I think governance can help us be successful in building businesses, and I think it comes down to, the fundamentals of transparency, candor, process.
There's a question over here, Joe, I think.
We're at the end of our time. All right, that's not a question, that's an instruction. I'm just going to make
we start at 9 o'clock, don't we?
We're going to, yeah, I know. I'm really good on timing. There's one really profound point here, and that is, if you look at all of the cases, if you look at the perception of Silicon Valley, outside of Silicon Valley, the dominant concern is that the preferred is somehow or other going to take advantage of the common, all right, or that there's some dispute within the stack of preferreds. What we've recently seen much more strongly is that a tremendous amount of negotiating leverage and power really is with the employee team, that there are sets of situations where the employee team, in effect, causes a deal to happen in a way that's inconsistent with the contract, all right, as a practical matter. The economics will flow, and they will not flow according to the preferences the way it's structured, because they're in effect side deals for management, for the employees, because that's what the market will support. And going back to Gordy and Larry's point, that these types of situations are more common, indicating that it's a much, much more robust equilibrium we have here in the Valley than you would ever know by simply reading the litigated and reported cases, is, I think, an awareness that we need to figure out how to spread in some ways, because it shows that the process works in a very particular and important way that you're never going to see illuminated through litigation, because these deals, these acqui-hires, they almost never lead to litigation because everybody always agrees to the deal at the end of the day. You got to do the deal, all right? It's the other type of transaction that more often leads to litigation, which leads to an asymmetric view of what actually happens in Silicon Valley. You get a certain category of disputes being litigated, another category of disputes almost always being resolved and never litigated. We're at the end of our time. Next panel, Evan. Thank you very much.